Very good afternoon, I think, yes. Very good afternoon to all of you. The idea of picking on this topic was practically to say that we are hearing a lot about RBC, risk-based capital. We've been through a lot of solvency regimes. The intention over the next 45, 50 odd minutes is to try and demystify some of the challenges, some of the quirks, some of the aspects, and then hopefully we benefit with the collective wisdom of the panelists I have on my left. So on that note, once again, a hearty welcome Abhishek, Prasun, and Rajesh. And Abhishek, especially to you. You happen to be my first boss. So Abhishek was my first boss when I started way back in 2004. So pleasure having you and hosting you.
Good to see you, Kailash.
Okay, so while we do a bit of a ice breaking, and that's what I'll term it as, right? Let's maybe, or maybe before jumping to the ice breaking session, right? See, the thought process that we should have is, and we'll invite for questions as well, to try and clear some of the air, try and clear some of the clouds, demystify some of the elements that we are talking about, keeping an eye on what we eventually want to achieve, and not just look at it as another capital regime, but to say that, look, this is where we want to go, keeping an eye both on the journey and the end goal. And that would be my 2 cents to the entire discussion, and that's something that we should keep in mind. So on that note, maybe a few ice-breaking questions, and then we'll try and keep it a bit light, just to warm up. So, and then we'll go quickly around the table. So one technicality, that is a real quirk, that's a real, detail, which according to you, Abhishek, is a real irritant. Why does it need to be there? But it is a technicality that you cannot ignore. Abhishek.
So I'll answer a slightly different question, maybe. So I think, like having seen a lot of regimes kind of move to a risk-based capital kind of a framework, I think one big challenge is how do you explain the results and outcomes to a wider audience without being too actuarial about it. So that has been a big challenge to my mind, and often underappreciated. And it's when you start getting the questions, when you're talking about the results at meetings, then that's when you start have to kind of really think about how do we explain it better.
Okay. Rajesh, maybe we'll go to the far left.
I think the biggest thing that I see is, and it creates confusion in the minds of everyone, is why you gave different numbers to the same things, right?
Okay.
It's the same item, but you say, no, in my financial reporting, this will be this. In RBC, this number will be different. In EV, this number will be different. And people really go crazy. Why the hell this same thing you are saying, but you are saying different numbers, right?
Sure. Okay. Prasun?
So for me, the most irritant part is the standard model. And we come out with one single shock factor for one risk component which gets applied equally to all the companies, irrespective of how well they are managed, how better they are managed, or against some of the companies, how less better managed. Irrespective of all these things, we apply one shock factor for a risk component equally applying to all the insurance companies. So that's the most irritant part of having a standard model.
Okay, that's helpful. One practical aspect that you believe is the easiest one to miss, but is very critical.
Like I think, Kailash, you talked about this being a journey.
Yeah.
And it'll usually be a long journey. It won't get solved in 6 months. And it's very easy to lose sight of the goals and objectives that you referred to. So the capital, to my mind, is one of the pillars of a good prudential regulation or a prudential management framework for an insurance company. Sure. Capital in itself will never answer all the questions, but it has to enable good risk management. It has to enable good risk-based decision making. Now, what I see is we tend to get too focused on the capital being precisely 1 in 200. So I think taking a step back through the journey, asking ourselves, whenever there's kind of a debate on any topic, like what is the end objective and what are we trying to achieve, rather than focusing on every micro debate and trying to find the solution. So that's something which I would strongly encourage as we go through this journey.
Okay, Prasun?
Yeah, I mean, again, coming from very basic discussions which I've been having with my senior colleagues in the organization, from the other departments. Thing is, most of the times questions get raised, why so much capital requirement? But the criticality which is missed out is, we look at very, very extreme events, and, it's maybe 1 in 200 or 1 in 100, 1 in 150. But that criticality gets missed out in the conversation. When he actually start explaining to these, stakeholders that it is such an extreme event, then they come to understand. So obviously, I'm saying that I have come up across such conversations where this particular criticality gets missed out in the discussion.
Rajesh?
Getting lost in details.
Get lost in details.
Counting the trees, forgetting the forest, is something that has been, I would say, bane. You get false sense of accuracy, something which, if you look at 2007 crash, that's what happened, right? You get lost into the models, believing that models are your answer to everything.
Yep.
Yeah, absolutely. I think the false sense of accuracy is a big pitfall. And I'm always reminded of a joke I read many years back when Solvency II was starting. Like, it's about, like, someone asked someone else how many sheep in the field, and they said, like, 5,002. So I said, well, why is it 5,002? Well, there's 2 near the fence and approximately 5,000 over there. So we need to avoid such pitfalls.
No, absolutely. Okay, and then the last one on the ice breaking. Rajesh, one reason for not implementing RBC?
More than 50 years in India, right? And this system is working.
So why rock the boat?
Why to rock the boat when it is working, right?
Okay.
You nationalized GI industry, PNC industry is the last one to be nationalized in 1970s.
Yep.
And the system is working pretty well.
Okay, Prasun? That was an easy one, already gone,
Yeah.
so you'll have to know.
Since you have said, so I will not repeat that.
Exactly.
I agree with that. One point I would like to add is, too many things happening at the same time. So it's IFRS, it's RBC. Obviously, when you look at isolatedly all these initiatives, they look very genuine with very noble cause. But unfortunately, a lot of things, all these things are happening at the same time. So that's the one burden I see on the industry.
Okay. Abhishek?
So I think, yeah, more along the lines what Prasun said, like resources and prioritization. So if it's kind of, if now is the right time or maybe a bit later, like I'm a strong believer in a risk-based capital system. And I think, like I've been asked this question, like what makes a capital standard a good standard? Like, is it that there have been no defaults in that industry, etc.? So, like, I think no capital standard will ever be a zero risk or zero default risk kind of capital standard. If we aim for that, we are holding too much capital, and that's probably not in the best interest of the customers in the industry. So where my answer to that question is, a capital standard that incentivizes good risk management is a good capital standard. And while what worked and will continue to work, like if it's overly prudent, you will not have a problem. But is that the best use of capital? Now that's like when, and like at a stage in the industry, you have to answer those questions. So India is in a very different phase, focus on growth. But as it starts maturing, getting more focus on managing capital more efficiently will become more important. So the time has to come, but again, resources and prioritization are important.
Absolutely. So yes, so we kind of heard, right, as to from a technicality to practical to why not RBC, right? So on that note, maybe let's scratch the surface a bit, split it up into, so we'll go with the traditional actuarial principles, and we'll say let there be questions or a small discussion around data, small discussions around the assumptions, and a small discussion around the methods. And these are the three pillars that we'll kind of focus the next, say, half an hour on. And then deep dive into analysis in terms of how do we interpret, right? So that's going to be the flow, and then we could go in any specific order, nothing really called out. So let's focus on the data and process related. And the first thing that comes to my mind, especially in the Indian environment, right, given the scantiness of data, given the paucity of structured data that we have, is it really worth it? How do we go about it? How do we do the analysis? How do we move ahead? Or do we look elsewhere? I don't know. Just other question. So yeah, go ahead, Prasun. Yeah.
Yeah, so, as part of this calibration exercise, we have studied number of literatures, calibration literatures. And what we found out is always, one has to make a start. And obviously, you will come across these challenges of small data set. But again, you have all the, flexibilities and the avenues to fall back on benchmarks which are taken from other regimes. But eventually, the important part, when we studied all these calibration literatures across major regimes, whether it's US, NAIC, or Solvency II oriented regimes, the foremost important thing is you have to, whatever calibration you do, it has to sync with the industry, the actual industry experience and the volatility. You cannot keep on benchmarking to the global benchmarks. At some point in time, you have to move to your own industry experience. So that is one. One technical aspect, what we found out is, when you looked at this calibration, see, you compare with 20 years data versus 100 years data. If, fortunately, if you get one extreme event in 20 years data set, that it is good enough to even, go for a outcome which is calibrated to 1 in 200 kind of event. I mean, if that is the end outcome, it does not necessarily have to be 200 or 100 years of data. If those 20 years data has black swan event or extreme event, and we have seen this, whether you apply parametric, non-parametric, all kind of calibration models, the results, end outcomes do not change because that 20-year data set is good enough because it has captured one black swan event.
Sure. Rajesh?
See, I think it's a myth to say 1 in a 200 year. Okay, I really don't believe that whenever they say it's 1 in a 200 year. Okay, you need to be pragmatic. Okay, and that level, even if you think about it, 1 in a 200 year event, as Abhishek highlighted, it doesn't make sense. It's no more a business. The cost will be so high that it probably doesn't make sense. And does policyholder is looking for that level of protection? Is also a question that you need to look for, right? Because that level of protection requires the level of premium which policyholder would have to pay. Is he also looking at that? So I think that's a myth, and hence what Prasun is saying is you will get limited amount of data. You can superimpose other jurisdictions, maybe not completely, but maybe to some extent of sigma or other parameters, not necessarily the mean, because mean is very crucial.
Sure.
And will be different. But other parameters you can superimpose. Maybe you can superimpose the shape of the curve. But those things you can do. May not be able to do complete, take the complete data, but some things you will be able to do with other pooling of the data. And you will have to live with that.
Sure. Fair enough. So Abhishek, on that note, and especially given your experience, right, cutting across multiple business units and geographies, is this, So twofold question. So A, is it really a problem that is unique to us sitting in India? And second, is there then merit in actually embarking on the journey of trying to do an internal calibration or internal models, enhancements, and so on and so forth?
I don't think it's a problem that is unique to India. So, like again, I speak from a life insurance perspective because that's where I've spent all my kind of career. And I'm sure, like from a non-life perspective, the considerations will be quite different. But like from a life side, like financial risks are a big risk for life companies. And usually, like again, globally, financial data has been easier. So you can actually calibrate statistical models using financial data, which are reasonably credible, and you don't have to apply a lot of judgment. But even for life companies, like if I look at, say, mortality rates now, like for global groups, like UK, for example, has like very good data available and a lot of data available. But we operate in multiple countries where the same challenges will exist. Similarly, persistency, the data will never be static. It will change with changes in product design, etc. How do you even calibrate that risk? So I'll use what you said, Rajesh. Like, we shouldn't aim for a false sense of kind of accuracy. We need an overall objective of protection. We use whatever data we have. We apply judgment. So, and we have also kind of explored some of the data augmentation techniques, for example, that are being used now in machine learning, AI spaces. But you always need to do a cost-benefit analysis. So, for example, like persistency is a big risk in many markets. Do I try to be accurate about whether the 1 in 200 stress has to be 35% or 30% or 40%? I don't think that changes the outcomes all that much. We have sufficient data to form good judgment on what a broadly equivalent stress should be. So instead of focusing time on trying to get accurate there, like what we normally do is apply judgment. As long as it seems correct or broadly in the same ballpark, let's move on and let's look at what is it telling us about the business. What do we need to do differently as a business to manage the risks better? So that's where I think the energy is better spent.
Sure. Prasun, anything from a PNC non-life standpoint?
Yeah, I mean, again, taking that same point of the problems with the standard model, one single shock factor, and all that. And especially for a large insurance company which is very diversified, and it's clearly seen in the QIS1 outcome also. When you look at the correlation factors which is prescribed, the level of diversification benefit coming out of there versus a very well diversified large insurance company, non-life insurance company may get maybe higher level of diversification benefit. So obviously there is a merit in terms of moving to internal capital modeling, but then it also comes with, as Abhishek is explaining, into the relevance of the data, the credibility of the data, whether it makes sense. Are you using that information in your day-to-day, decision making, in your judgments, actual valuation, pricing? So that is equally important because we have seen, when the regulators have actually allowed internal capital modeling, they actually went piece by piece, not allowing in entirety. And looking at the, use case, the calibration, the statistical test, all those stuff, More important is use case, how relevant you are and are you using that information in your day-to-day decision making. That is more important. But obviously, as a large PNC, obviously there is a merit in moving to internal capital modeling, but that will require a lot of skill set, capacity building, so that is,
Sure. Rajesh, any views and maybe a follow-up question? Once a model is calibrated, what should be the frequency of calibration going forward?
Yeah,
Based
so
on your,
see, I believe this internal model you are talking about is from the perspective of regulatory arbitrage probably. Okay. The way I say it is companies who will see that reduction in the capital will go for internal model and do it, right? It's the same adverse selection which is going to happen. And companies who see that capital is going to go up will not go for internal models.
I'll come to that later, but yeah, please go ahead.
And hence, see, theoretically, idea is great. Idea is great that everyone's risk is likely to be different unless it is a large diversified company which has all over India risk and two companies are similar, likely to be similar risk. But otherwise, in theory, yes, you are right that companies have different exposures and different risk. And hence, having an internal model is going to give a better handle on that. Okay? The question is, who is really going to do this? Right?
Yeah.
In the context, and should regulator allow that internal model? Okay? Will the regulator be able to really go through this whole thing of calibration exercise which an internal model needs to go through, right? And that level of scrutiny will be required at the regulatory level also. So, should it be done? Should it be done at the first instance? Should it be done at a later stage? Are all the questions which regulator will have to evaluate. And as I said, it is moral hazard from the regulatory perspective.
Sure. Okay, as a good practice, what should be the frequency of calibration? As in, you've done it once, transition has happened, assess it every year, every second year, every fifth year, every 6 months?
So, answer is, this exercise takes a lot of effort and time, okay?
Yep.
And data is not going to change overnight, okay? So, it's not that you are going to get a very different answer if you repeat exercise every year, okay? My gut feel says it should be somewhere around maybe one economic business cycle, which will be like 7 years around.
Oh, okay.
For economic parameters maybe, okay? And even non-economic parameters which are insurance risk related, okay? Those maybe around 10 years or so, because you don't see mortality trend or things like that really changing so fast, or even your earthquake risk or flood risk not changing so fast, okay? So that's where I would say the frequency maybe. Operational risk can be more
frequent.
More frequent because that's a thing which can change dramatically over.
Sure. Prasun, any gut feel answer on
You
that?
know, just to add on to what he's saying, see, we are talking about extreme events, and say, even in next 1 year, if there is unfortunately one extreme event happens, so then even next 1 year, after next 1 year of calibration may give a very different outcome. So that is one, which is unlikely, but you also have to look at, I completely agree what Rajesh has said, but if there are black swan events in next 1 year or 2 years, the moment to redo the calibrations using that information in next 1 year or 2 years, you will get a very different outcome. In addition to the black swan and the extreme events, I think the other aspect what needs to be looked at is if there are very one-off trends which has emerged recently, not seen in the past, so that may also might change your calibration outcome. So I think these need to be, it cannot be a rigid number, 3 years, 4 years, or 7 years. Sure. That's the point, I have to make.
Abhishek, you've been a party to a few RBC implementations.
Yes.
Your take on it?
So, before we demerge our businesses, we were regulated by the PRA as a group, and we had implemented an internal model for Solvency II. So at the time, the standards we had set for ourselves was we would refresh, for financial risks and where things can move, we would refresh our calibrations annually. So just add 1 year's data and see whether things are moving or not. Now, would it change the answer on what is a 1 in 200 event? It wouldn't. But it's also about what else are you using it for. So if you're also looking at the body of the distribution to try and manage things more kind of closely, that's when the utility is there. So where I'm kind of getting to, everything as a cost and benefit. So think about, why do you need to review it very frequently? If there's a need, what is the cost? And do you need to do it for all risk parameters or some risk parameters? And if you don't recalibrate every year, what else can you do to have the right guardrails? So we also had a trigger framework. So we would look at, say, interest rates, like for each of the geographies, how much are they moving? And we would have a tolerance. If in a particular year interest rates moved by more than X, then we would go back and revisit. And where we actually had to go kind of like out of our way to kind of review some of our risk models was when interest rates started going negative in many of the markets. Now that, like conventional wisdom prior to that was interest rates would not become negative, so none of the calibrations would reflect that risk. So that's an example where we went and actually changed our models to reflect that risk. So agree, there should not be a standard rule. You need to kind of, at the end of it, the objective is that your calibrations reflect the risk. If there are reasons why you believe the risks have changed materially, yes. If you want to use the distribution also in the body and not just in the tail, yes, but it comes at a cost. So is the cost worth it? And be pragmatic about it. And I'll keep reminding everyone of what Rajesh said earlier. Don't fall into the trap of false sense of accuracy here.
Yeah. False sense of accuracy or false sense of, peaceful sleep at night, that I'm well capitalized if I hold money up to that level. Okay, let's maybe switch tracks a bit, right? And then switch gears towards methodology aspects, because we talked about some of the quirks around persistency, black swan events influencing, and so on and so forth, right? So switching gears to methodology, and given the experience, maybe Abhishek again would probably start with you, which could be and as an Indian environment ecosystem, we've embarked on the journey of IRBC or the Indian RBC, right? And then we've done a Quest 1, Quest 2 is underway. But if you were to kind of take a step back and say that, look, is there a role model geography that could be a good starting point? Which could that be, and for what aspect?
So, like I would say we should look at what, like, we are standing on the shoulders of people who have already done it in many parts of the world. So just focusing on one is not necessary. Mm-hmm. We can learn from things that have gone well. We can learn from things that have not gone well. Mm-hmm. And honestly, a lot of the work has now been done by the IAIS. So the ICS capital standard has been now adopted. Is it perfect? Like, I won't say it is perfect. Like, that I'm sure many people will have different views on it. But it's a good template to start with. And the trend in Asia is to take it as a template and then modify it to the local needs. And there can be multiple reasons why that happens. So to me, that's a practical kind of starting point. ICS is also is aligned with Solvency II in many ways, but it is more practical in some ways. The calibration of the risks, again, have taken into account kind of inputs from multiple jurisdictions. So that may or may not necessarily hold for India, but it's a good starting point and see, does this work? If it doesn't, how do I alter it? Or if I look at my data, does it kind of support this good enough or not? So that is one way to kind of go about embarking on this journey. Now, more specifically in Asia, like if I look at like Hong Kong RBC has been one of the recent ones. Yep. They have been more true to ICS, but they've gone kind of a step further in many ways. So for example, discounting liabilities is the discount rate is a key topic of kind of interest, especially for life companies. So the more generous is the discount rate, the better it is for the companies. So you have to find the right balance. What do you want to achieve as a country? So they've gone a certain distance. Singapore has done it differently. There are other aspects which are like China has done it very differently. They use averaging of interest rates over time. So all of these have consequences. So take a step back. What is it that we want to achieve over here? If we want to encourage growth and if capital is constrained, we don't want to make the capital standard very onerous. If we go a very purist market consistent route, offering guarantees will become more difficult and more expensive. Yep. What do we want to achieve as a wider agenda? If we believe the guarantees are going to be important for life insurance customers in India, we should not completely discourage it, but we should have it in a way that it is done sensibly. So have the right checks and balances. So that's kind of a long answer to your question.
No, but that's a very fair perspective Abhishek brought to the table. Prasun, maybe just continuing on that thread, right? And maybe more so in a PNC world, right? We've got a few lines of businesses, say motor third party, for example, right? Where the prices are regulated in a way, right? Given that construct, what's your take on whether you should have it? How would you go about it, right? Because the prices are fixed, right? Your hands are tied, and then you have to honor. So how do you go about it?
Yeah, I think this is the first point we deliberated, and very natural to have this question, that it's a tariff-driven product, then why should we penalized for any kind of volatility, adverse volatility, which might arise. But, if you look at from conceptual and principal point of view, I said any solvency, any RBC is a total balance sheet approach, where we look at each and every line item of the balance sheet. Each and every line item of the balance sheet is recasted to a fair value. And then what we look at is how those fair values of those line items change under extreme stress conditions, And that is how the whole capital charge, is calibrated or estimated, how those fair values change in those extreme conditions. Now, fundamentally, if you look at whether it's tariff-driven or not tariff-driven, nothing changes, What we really look at is how those, under extreme situations, those fair values change for each of those line items, and hence that should be the starting basis for at least estimating, calibrating the capital charge. Subsequently, yes, of course, if there is an impact which is arising only because of these tariffs, then I think it's a obviously understanding the the underlying reasons for such adverse volatility. I think it's a regulatory call to to give dispensation or make it in a staggered manner. If there is adverse impact, and how do we allow the insurance companies to absorb this adverse impact in a staggered manner, or do more fundamental changes in the pricing to make it more palatable.
Sure. Rajesh, maybe continuing on that thread, right? While motor third party is one element, but there could be a few, how do I put it across, maybe say not directly quantifiable, not say a pure financial risk, could be an operational risk, could be say a liquidity risk assessment and so on and so forth, right? Which will need to be measured, calibrated, and then you come up with a stress or a shock. Any thoughts on how one could go about that? What are the challenges? What is it that you watch out for? So something which is not that easy or a cakewalk, right?
Yeah, so I would say current measure is kind of apply the same yardstick to everyone on that. My thought process is that we need to probably align that to internal controls.
Okay.
Their audit findings, complaints, issues, events in the company, inspections, which our regulator and other agencies do, and link it to those. It should not be simply a straight parameter applied like what we do currently in many regimes. And if you link it to those, then I think it is a better metrics.
Okay, fair enough. Maybe switching gears and then again trying to get some humor in it, a pure gut feel answer to this one, based on again maybe experience around Solvency II, RBCs, HK, Singapore, and others, right? Are insurers generally overcapitalized or undercapitalized compared to, say, the other financial services players like banks, NBFCs, and these sorts? So what's been, and it's a pure gut feel, answer. There's no way to challenge whatever you say, or but yeah, generally as a gut feel, are we as insurers overcapitalized or undercapitalized compared to our peer financial services?
Probably overcapitalized,
Okay.
going by experiences of failures in the insurance industry and failures in other financial banks and NBFCs. If you look at even last 20-year data,
Yeah.
globally, you will see that failure at insurance companies are far lesser compared to other financial services. So if you ask me, we are probably overcapitalized. Second thing also you need to say is that it's not that same risk and same magnitude applies to all the industries, right? Liquidity risk, for example, in banks is paramount, far more important. Any run on a bank, we can kill the bank completely, right? Whereas liquidity risk in the insurance company will be pretty low, okay, compared to a bank or even an NBFC. NBFC liquidity risk only arises when you have to pay the debt, which is known. You know the debt schedules, right? Whereas, so NBFC is probably at the lowest end of liquidity risk compared to bank and insurance companies in between, right? So each have a different risk, impact and all that. And because insurance risks are complex and we don't understand that, right? And it is very small portion of the industry or people who are invested in it is where probably the capital requirement also has gone up far more. So you can understand how the Solvency I was there where simple risk factor, somebody decided and continued for years. So it's my gut feel is that it is because that we don't understand the nature, we don't have the data also. So because of that, we have been over conservative compared to other industries.
Compared to other industries. Okay, fair enough. And Abhishek, I presume that's a sense globally or is based on, say, your connects with investors, street?
Yeah, so I think if you look at the recent trends, the investors obviously feel insurers are very well capitalized and there's a lot of focus on returning capital to shareholders. But
yes, that's another parallel, sure.
But I think, yeah, like it's very difficult, like as Rajesh said, like there's, like capital is one aspect, like things can go wrong because of many things. I'll go back to what I said earlier. Like the whole, like management and supervision requires a full toolkit. Capital is one of the tools in the toolkit. It's a hammer. All problems will not be solved by a hammer. All problems will not be caused by a hammer. Sometimes you need a screwdriver as well. So you need to look at the overall framework of what is the capital standard, what is the like control framework, governance standards, what are the risk management requirements and standards. Rajesh kind of talked about liquidity. You can't hold capital for liquidity. It has to be managed differently. Like you have stress and scenario testing, you have own risk and solvency assessments. So how do you effectively create a toolkit which helps you manage the whole thing holistically? Sure. And you may be overcapitalized, but you can still fail because there were no adequate controls and there was a fat finger error. No amount of capital will solve for that.
True, true. Okay, maybe we're switching gears and talking about, say, transition, right? Transitioning from Solvency I regime to an RBC regime. Is there a possibility / a mechanism to roll out or do an RBC rollout in a phased manner? Or does it have to be like, no, we've got to transition lock, stock, barrel, one fine day and then be on RBC? Maybe, anyone, Prasun, go on.
Yeah, I mean, so obviously when we were looking at this new RBC format, there was a hope that there would be one-off capital surplus because, you know, the level of, you know, the hope in terms of, obviously people were, especially for companies who have a large, long-tailed book, you know, the discounting benefit would be significantly higher than any additional increase in the risk capital, you know. So with that hope, I think there was a lot of talks going on. But unfortunately, QIS1 has not given that sort of sense. So whether it's capital surplus or capital deficit, there are mechanisms, you know, and we have seen both sides, you know. So in capital surplus also. Don't want to name the regime. So what the regulators have done is they have a kind of ring fence that capital one of surplus and allowed that capital surplus to be released in a sequential manner, in a phased manner, in over a period of say 5 years, 7 years. Equally, when there are capital deficit, obviously there are ways to handle this is you can lower the level of overall capital requirement initially to start with, and then sequentially and gradually increase that level of requirement over a period so that the insurance companies get necessary time and space to mobilize their resources and capital. So I think I just wanted to give that.
Okay, that's it. Abhishek, yeah, sure.
Yeah, so like when it comes to these things, like my preference is not to go for hybrid solutions because you're either here or you're there. Like trying to be somewhere in the middle makes it a lot more confusing and a lot more difficult to manage. But equally important, the points that were made. Like you can't create a disruption in the industry because you want to make a positive change. And the disruption could be a positive or a negative. So like at least the way I think, it's important to know where you want to get to, build the frameworks according to that, and have transitional arrangements. So if the industry, if the consensus is industry is overcapitalized, okay, maybe don't return, like use all of the capital at once and as Prasun said, like use it over time. If it's undercapitalized, the companies cannot become like insolvent overnight. There has to be a process and time for recapitalization of the industry. Similarly, like as I said, capital is one of the elements. You also need to strengthen governance frameworks maybe, or include other aspects of risk management which have been previously not there, because RBC might create different like incentives for risk management. So all of that will take time to implement. So having an agreed time frame with the industry and a sensible transition process with appropriate guardrails is extremely important for orderly implementation of any massive regulatory change.
Sure, that's fair. Rajesh, switching gears to RBC, will it complicate the lives of the investors and the street analysts, or will it actually make it easier for them to understand the business? Relatively, compared to where we are today, right?
So I would say answer depends whether the regulator harmonizes RBC with IFRS 17 change, which is again going to happen, right?
Sure.
And both probably comes nearly the same time, and without creating, as I said, multiple numbers to the analyst, right?
Right.
So then, yes, it is probably a better approach from that perspective where analysts can understand easily.
Easily. So the idea is to
relate
do
to
both
the
together.
numbers, they are the same numbers, right?
Sure.
If both diverges, one goes in this direction and one says in another direction, and you again produce two different set of numbers and metrics, etc., then it becomes a challenge.
Yep.
It becomes a challenge, and I would say that it will not be that easy.
Sure. Prasun, your take? Similar or a different view?
I mean, slightly different. I mean, just look at from RBC perspective versus what is currently there. So obviously, my view is that investors would get more detailed information. There will be more fairness to the disclosures. For example, you'll get a breakup of liabilities. You have best estimate, you have risk margin, and you also have a fair value of best estimate, which is discounted. Obviously, investors would see these. They would see these components,
Sure.
and equally they will see similar components in the other, insurance disclosures also. So from that perspective, there will be more fairness, more transparency in terms of more detailing. But obviously, one can always question the level of discounting depends on how the individual companies project their cash flows, incremental cash flows, and the timing of those cash flows. So naturally, we will not answer everything, but at least from the more detailing perspective, I think it's just help the investors, on a fair value basis.
Okay, that's helpful. So, Abhishek, maybe coming back to you, right? Now, given that gut feel that we should go down RBC because we are A, overcapitalized, B, it should free up some capital, and C, that capital can be deployed to garner more business. what's your take in terms of, so two parts to it. One, could we look at a tiering approach on this sudden surplus being generated? How do we deal with it? Where does that flow in? Is it released straight to the P&L, or is it available for dividend distribution, blah, blah, blah? That's one. And second, how do we actually embark on it? Is there a roadmap based on, again, how it's been done? Any thoughts, views, suggestions?
So like the tiering, etc., like again, that, like subordinated debt, for example, as a source of capital will be tier 2 unless it's kind of perpetual. The ICS again has set out a framework on how you can assess various kind of sources of capital on a balance sheet. I think the most challenging discussion is around the kind of either negative reserves for certain lines of business, or reserves being lower than current surrender values, or like fees that you will earn in the future. Do you treat it as the same like quality of capital as, say, equity capital or not? And again, different views have been taken. The topic was debated a lot under Solvency II as well. So under Solvency II, it's all tier 1 capital. Hong Kong, it's largely tier 1 capital.
Okay.
But like Singapore treats some of that as tier 2 capital. Now that's partly also been driven by tax considerations because they didn't want to create a discontinuity on liability measurement for tax.
Sure.
So that's one way. Like you could, like the big increase in capital will come because you're removing the prudence from your liabilities. You're holding much lower liabilities. You're recognizing future profits of future cash that will emerge in today's measurement. Do you assume you've got the cash in bank and spend it, or do you keep it? So that's where the tiering, etc., can help. But you have to define what is the objective and what are the fears. Now, are there other guardrails to do it? Yes, there will be other guardrails to do it as well. So, for example, at the end of it, cash will be a constraint. So, if a company which is writing a lot of protection business and has a lot of negative reserves, will not be able to do a lot with it because it won't have cash to pay out as dividend or invest in elsewhere. Yeah. So that's a guardrail. Now, so that's the framework.
Sure.
So you can have, like, key decision would be how do you treat future profitability? Do you treat it separately, tier it separately or not? And it will have its pros and cons. So there's no right answer there. You have to kind of go back to what is the objective and then determine. The other question is, like, once you've got the framework, then what is the answer you're getting? Now, if it is releasing a lot of capital, that's where the transitionals will have to come in. Do you want to release it at one go, or do you want to release it over time? Or if the answer is there's a big deficit, do you want to fill that deficit in 1 year, or 5 years, or 10 years? You also have to look into what is the market reality. You don't want to be disruptive. So there's no fixed answer, but need to separate the transitional discussion with the framework discussion.
Sure. No, I'm getting signals for time being up, and we would definitely want to open the floor for maybe 2 quick questions. And then while you guys decide your question and do a show of hands, I think hopefully this did clear some of the doubts, some of the air. It helped demystify the whole thing. My take, at least based on the inputs that I received today, was choose your shade of gray. Choose what you want to achieve when you embark on RBC as a construct. Don't just be another cog in the wheel and take whatever comes out of it for granted, right? Interpret it and let the business determine the shade of gray that you kind of, and that's my take personally, but we'll just throw the floor open for questions, maybe 2 quick questions. If there are any, else we could wrap up the session. Any brave souls who are not hungry yet? Oh yes,
Kailash,
there is one hand. There's one hand in the center. I think your handset is not working. Nope, we can't hear you. Could we get another mic? So there was one hand and I had one hand here. Okay, so those 2. Nope, can't hear you. You want to take this? This one's working. Just pass this. There it is.
Yeah, I hope I'm audible now. I have two questions. I'll ask one probably now. So answer to this question might help me absorb the discussion better. So how would you prefer the RBC to work, or how would you like it to be seen? To be act just as a cushion for the insurance companies, or as a full-blown armor, which would be like more cost intensive or would be difficult to handle? Or just as a cushion which would be give you relief just from the smaller risk, smaller blows, but might fail to cover you from the bigger events.
Okay, who wants to? One?
So I think just look at the landscape, how it is changing, I'll give you a very short answer to this. If you look at the recent, I think last 1 year, there have been a lot of regulations getting open-ended, more flexible. Is giving a lot of flexibility, to all the insurance players in the industry. But equally, I think then it becomes very important to create that commensurate governance mechanism also. Because you are making more flexible regulations, more open-ended, trying to create innovations, and those come at higher risk. And obviously, it's equally important to create those commensurate governance mechanisms in terms of RBC, even IFRS to that extent, bring more transparency. I think to answer you short, I think this is one thing I see personally, that this is just a balancing mechanism, which is being done through RBC as one of the frameworks.
Okay, and I'm sorry,
Yeah,
we'll have to make it
sorry.
quick.
Yeah.
Okay.
So it's a quick question. Mr. Abhishek is there in the international market, seen the implementation of RBC. So from the angle of corporate governance, we actually discussed a lot of aspects from that angle. So preparedness in India from the angle of corporate governance, when you see international market and Indian market, whether we are really ready from that angle to implement RBC. Thank you.
Yeah, I think, I've not been that close on India, but at least what I see for our joint venture, the standards of corporate governance in India are also pretty good. So I don't see that as a challenge. So when I'm saying we need to make sure everything is fit for purpose, that doesn't mean it's not fit for purpose. But if you implement RBC, the board will need to understand it. So you have to do more things to make sure that the board understands what that means. Now, it might change the way you look at asset liability management. So there might be a need to change some of your policies or some of your processes, etc. So things will need to evolve, irrespective of how good it is currently. So it's starting from a position of strength. How do you then make the necessary changes? Or it may not be changes. It's about educating the whole system or making the small tweaks necessary to just align with. So you've got a new hammer in your toolkit. Maybe some of the other tools need to be just polished up to work with the new hammer, maybe.
Okay, Rajesh, last comment.
Yeah, I just want to add
Suvendu
to
is looking at me, not very good looks.
add to what Abhishek said. Corporate governance framework is almost similar and same. It's just like we also have traffic lights here compared to the traffic lights in UK, right? Will you stop if there is no policeman here? And will you stop if there is no policeman in UK, right? And that, I think, is where the difference comes in. It's not about corporate governance, structures, framework.
Correct.
There is a problem.
Sure.
There's a big thing about what incentives are there for management and what checks and balances are there for management in the whole framework. They exist, but are they adequate?
Cool. Thank you so much, Abhishek, Prasun, Rajesh. It was wonderful having you on the stage. Thank you very much.
Thank you.
Thank you.